Hello there. Today we will learn how to mind map IAS-38 intangible assets. Before going further, we need to understand IAS-38 intangible assets. Intangible asset is an identifiable non-monetary asset without physical substance. An intangible asset is identifiable when it is separable, or arises from contractual or other legal rights, regardless of whether those rights are transferable or separable from the entity or from other rights and obligations. Examples of intangible assets: patented technology, computer software, databases and trade secrets. Trademarks, trade dress, newspaper mastheads, internet domains. Customer lists. Mortgage servicing rights. IAS-38 applies to all intangible assets other than financial assets, exploration and evaluation assets, expenditure on the development and extraction of minerals, oil, natural gas, and similar resources, intangible assets arising from insurance contracts issued by insurance companies, intangible assets covered by another IFRS. Recognition and accounting treatment. For intangible assets: purchased separately, exchange transactions, granted by government, acquired in business combination, internally generated. Purchased separately. These are recognized and capitalized at cost, purchased price. Exchange transaction. An intangible asset may be acquired in exchange or part exchange of another intangible asset. The cost of such item is measured at fair value, granted by government. These are measured at fair value of normal amount, plus any expenditure incurred. Acquired in business combination. Recognize any intangible asset so acquired at its fair value. This may include any research and development in progress of a query. Internally generated. Costs incurred on internally generated intangible assets are incurred at research phase and development stage. Research costs. Examples include obtaining new knowledge, search for application of knowledge and material, testing of materials. Research costs are expense out as incurred. Development costs. Capitalize as intangible if all of following are met. Project is technically feasible to complete. Company intends to complete the project. It is capable of being used, sold, and future benefits can be generated. Resources are available to complete it. Development expenditure can be measured reliably. Subsequent measurement of intangible asset. The entity may use a cost model, or revaluation model for accounting for intangible assets. Cost model. An intangible asset is carried as its cost, less any accumulated depreciation and impairment loss after initial recognition. Cost includes expenditure on material and services used, salaries, wages and other employment-related costs directly engaged in generating the asset. Cost prohibited. Selling and administration overheads. Initial operating losses. Training expenditure. Revaluation model. Very rare in practice. Intangible assets may be carried at a revalued amount, based on fair value, less any subsequent amortization and impairment losses only if fair value can be determined by reference to an active market. Amortization of intangible assets. With finite life, or indefinite life, finite life. Asset must be amortized over its life. Amortization method should reflect the pattern in which assets' future economic benefits are expected to be consumed. If that pattern cannot be determined reliably, use straight line method. Indefinite life. The asset should not be amortized, but impairment review should carried out annually. The life should be reviewed each period. The change in life is a change in accounting estimate in accordance with IAS-38. Thanks for watching. More stuff coming soon.